In this presentation, we will add inventory purchases from bank feeds into QuickBooks Online. Here we are in our Get Great Guitars file. We're going to first start off by opening up our reports. As always, this is typically how I would recommend basically working with QuickBooks Online. Have your reports on the right. I'm going to open up the balance sheet. Have your other tab on the left so that you can then enter your data and then bounce back and forth from the reports to see what QuickBooks does with it. I'm going to change the dates from 01/01/20 to 12/31/20. We're going to run that report. Then I'm going to right click on the tab up top and I'm going to duplicate that tab. Then I'm going to go back to the tab to the left and do this again for the P&L, the profit and loss, the income statement. So there it is, opening that up. We're going to change the dates for it as well. It's going to be the same date ranges, that being 01/01/20 to 12/31/20. We're going to go ahead and run that report. Then we'll duplicate things up top. I'm going to right click up top and duplicate. Right click and duplicate. So there we have that. Now let's just consider inventory, because inventory is one of those areas where we have issues. Now, if you're in a service company, you don't have an issue with inventory because there's no problem. You're not buying and selling goods, possibly buying, marking up, and selling. In our case, we're pretending we're being a seller of guitars, and therefore part of our income comes from buying guitars, marking the guitars up, and selling them at retail at a marked up price. So that's going to be part of our income up top for the sales of product. So we have the sales of product. That's going to be part of our process. So how would we do that with basically the bank feeds? We kind of have to use some type of flow assumption, because note that inventory in and of itself means that we're on an accrual basis. It's forcing us to be on an accrual basis with regards to the inventory, the purchase flow, because when we pay for something, even if we pay for cash, we're not expensing it at that point in time, but instead putting it on the books as inventory. So let's jump over to our QuickBooks desktop cash flow, or desktop version, just for the home page, so we can see the normal flow within QuickBooks related to inventory. So we're actually up here in the vendors. Inventory clearly goes through the vendors that we purchase the inventory from, then to customers as we invoice. So the normal process that would go through for someone that purchases and sells inventory, for example, us, we purchase guitars, mark them up, sell the guitars, would be possibly we have a purchase order asking the vendor for guitars. We don't pay anybody at this point in time. A purchase order is different than like an online order. We're not paying for something with the use of a purchase order. It's just an information form. We actually wait till they give us the inventory and then we pay at that point. That's what a purchase order would do. So whether you purchase order or not, or just pay at the point in time of purchase, at some point you'd pay for it. And then we'd enter the bill. And then the bill would typically be us increasing the accounts payable we owe the vendor and increasing inventory. That's when we would put the inventory on the books, that being kind of an expense. And then we could pay for the inventory, decreasing the AP accounts payable and decreasing the cash. Or we could just think of it as we're buying inventory with cash, decreasing cash, and increasing the inventory. If we jump right to that point, we're buying the inventory, decreasing cash, increasing the inventory. So that means that we basically kind of like with the equipment, the property, plant, and equipment, the furniture, we capitalized the inventory as an asset that we're going to use to help us generate revenue in the future, and therefore it's an asset, not an expense at the point in time of purchase. Therefore, we're on an accrual basis as opposed to a cash basis. Then in the future, we're hoping to either invoice people for that inventory that we will sell, or just simply have it sell in like in the store, which we would create a sales receipt and just make the sale in the store, at which point in time the inventory would go down, and then we would record the related expense, the cost of goods sold. In other words, if we're imagining we had the store, then someone comes into the store, buys the guitar from us, then we're going to record the sales receipt, which is kind of a complex form. What happens with a sales receipt? It's going to be increasing the cash in some way, possibly undeposited funds. We'll talk about that later. And then it's going to be decreasing, or it's also increasing revenue, the income account. It's going to be decreasing inventory, and then it's going to be increasing cost of goods sold. And we also might have to deal with basically sales tax with this form. Now, when we look at bank feeds, well, how is bank feeds going to fit into it? Well, we're going to have a deposit side of things we're not thinking about now, and we're going to have the expense side of things, or the money going outside of things, which is us paying for the inventory. So we have a few different options. If we want to basically have QuickBooks track the inventory within the QuickBooks system, we would have to set up items and then basically record the transaction within QuickBooks and then match that transaction up with the bank feeds. And the reason we would need to do that is to enter the transaction, the items, into the QuickBooks system. However, maybe you're okay with not having QuickBooks track the inventory items, like in our case, the actual guitars. Maybe you're saying, hey, I could track the guitars outside of QuickBooks, or maybe I don't have a lot of guitars to track because I buy a just-in-time kind of system. They order it and then I buy it right after that, so I don't really have a whole lot of inventory on hand. I buy it quickly, or I have some other system to track the inventory. If you want to track the inventory then outside of the system in some other kind of system and use QuickBooks just to record the financial transaction, you could record the purchase of the inventory as simply going to the account of inventory without having the service item in there. In other words, you're not telling QuickBooks what you purchased in terms of the type of guitar, but simply that you purchased inventory. Then you're going to have your sub ledger of what you purchased in some other fashion outside of QuickBooks so you can track how much inventory you actually have. Or the third option, and the easiest option, the kind of cash basis option, cash basis for inventory, would simply be to say, hey, I don't have a lot of inventory on here. Basically, if you're a contractor or something like that and you're buying wood or things like that you're then going to use on a particular project, then you might just say, hey, it's easiest for me to just expense it now, right? Because I'm just gonna expense it. Or even our guitars, we might say, look, I'm just gonna buy a guitar which I custom purchased for this person. I'm just gonna buy it, turn around, and sell it to them, and therefore, I want to just put it in the books as an expense right now and not deal with capitalizing at all. Just be on a cash basis system, even though we have basically that inventory. And if you do that, that's the easiest, way of doing it. So in that case, for us, when we buy the guitar, we would simply be expensing it to, say, cost of goods sold, even though there's a bit of a timing difference between the point in time that we purchased the guitar and the point in time that we're going to sell the guitar. So if there's a limited amount of inventory, you might look at that. So what we'll do here is we'll look at the cash basis system right now, imagining we don't have much inventory or we're doing a just-in-time system, and then in the second month, we'll apply the inventory to an inventory account and take a look at those two methods. And then after this project as a whole, we'll take a look at how to basically apply out the inventory and match transactions to do the full service inventory, which would be to record the inventory, see the outflow, record the outflow in QuickBooks, and then when it goes to the bank feeds, to match those transactions to make sure that you haven't entered it 2 times. Basically just having the QuickBooks double check that you input that into the system. Okay, let's go to the banking. Let's start on the banking tab, and then we're gonna apply first kind of like the simple method, right? So we're gonna scroll down. I'm gonna look for my vendors that I know I purchase inventory from. So we buy guitars. These 3, Epiphone, Gibson, and Epiphone here. These are vendor transactions. So I'm not gonna track the guitar that I purchased. I know I purchased guitars here. I'm gonna close the hamburger up, by the way. I know I purchased guitars, but I don't want to track the actual items in QuickBooks because it's too much time for I'm going to say that I just want to do this as quickly as possible. I don't hold on to the guitars that long, and therefore I'm going to try to basically be on a cash method, even though I have inventory, and just expense this thing, not have to, and then it'll just expense it and be done with it, and I won't have to do any other tracking of it. That's the easiest thing to do. But if I have a lot of inventory at any given time, then that causes problems. And just realize that the IRS at some point, when you're looking at taxes, inventory is one of those things where the IRS basically says, hey, if you got a significant amount of inventory, we would like you to be on an accrual basis because it is something that distorts the reporting quite a bit, and therefore just realize that. So here we go. I'm going to say, okay, here's the Epiphone. We're going to open that up, and it doesn't know where to put it. It went into uncategorized. So again, if I was going to capitalize it, put it on the books as inventory, I could take it simply to the asset account, another current asset account, if I scroll down, of inventory or inventory asset, and other current asset, which would put it on the balance sheet. But then I'd have to track some time of when I sold it, and I'd have to record another transaction reducing it from the balance sheet to the income statement. And I don't want to do that. What I'd like to do is just record it as an expense right now. And then when I make the invoice, or when I actually sell the guitar, it'll be easier because I don't have to do part of that transaction, which is to decrease the inventory asset and record the cost of goods sold, or do the tracking of the inventory within QuickBooks. Because I've already done that half of the transaction here. I kind of skipped putting it on the books and taking it off on the balance sheet and then taking it off. I just went directly to the income statement, as if for the expense side of things, we recorded the purchase and the sale, at this point in time, at the point in time of purchase. And then we'll record the sales half of the transaction, revenue going up and cash going up when we actually get the deposit from the customer. So here I'm just going to be I'm looking for a cost of goods sold expense type. So here it is, cost of goods sold. So that's the one I want. I'm just going to go right to cost of goods sold. And then you could put a memo down here, and then it's going to memorize to edit this transaction. So we'll set it to memorize that. I don't want it to do that because next month I'm going to try the next method, which is to put it into inventory. So I'm going to say, no, don't do that. Leave this one as is. Leave Epiphone as, or create custom rule. So I'm going to leave it Epiphone uncategorized and say save, record that. All right, then if I go back up to the balance sheet and see what happens, I'm going to close the hamburger, hold down control, scroll up just a bit to that 125. I'm going to go into the checking account. It's probably not refreshed right now, but it will be once I click on it, meaning the numbers will change to pick up that new item. Scrolling back down, we're going to see that we have Epiphone. There's Epiphone, and there's the cost, $400 for Epiphone. It went into, once again, I believe an expense form. So we're just using an expense form here. So here's the expense form. Now note that it just went to the category. If we were tracking items, the inventory items, listing the Qatar, we would have to use the items detail down here. And that's what we would need to do that. So we're not doing that. And we didn't even put it to inventory. We just put it directly to basically the expense. Closing this back out, scrolling back up top. Then I'm going to go back to our balance sheet. And then the other side note is not going into inventory, like it kind of should right now. But we're basically saying there's just a small timing difference between the sales point and this point. Therefore, we expensed it at this time. The easiest thing to do, which is to go to the P&L, and then I'll refresh the P&L. And then if I close this tab and I go back down to the cost of goods sold, here's the cost of goods sold, the expense of us selling a guitar, which again, we haven't yet sold, but it's going to be close because we do those things at the same time. Here it is, Epiphone, and there it is, other side being the checking account. Now notice all these other ones, we don't see any expense items down here because for the first 2 months we did the full service process, which is that when we see this side of things, the cost of goods sold is usually driven by an invoice or a sales receipt, because the invoice or sales receipt are the items that usually track the inventory, record the decrease in inventory. But again, we didn't want to put the inventory on the books and track it within QuickBooks because that will complicate things. And we're basically saying we're on a cash basis system. So we expensed it here at the point in time of purchase. We're going to make the invoice later. When we make the invoice, rather than having the invoice decrease the inventory account, we're just simply going to record the sales side of things and the cash going up. And then you have to think about and deal with sales tax transactions for that as well. Okay, let's do the same thing for the other two. I'm going to go back over here. Again, we're basically doing a cash basis transaction. Here's Gibson. So I'm going to open up Gibson. Now it memorized the transaction here, or it found it. That's what it means by this recognized transaction, or why it was green. I'm not going to put it to inventory, however. I'm going to be putting it, because it remembered that from the last time when we did January and February. I want to put it to cost of goods sold. I'm going to go ahead and type it in there, cost of goods sold. We're going to pick up cost of goods sold and then not apply it to a particular customer. And then it's going to try to save this again. I don't want it to save this one. So I'm going to say don't save this transaction. And then I'm going to say add. So we're going to add that one. And then I'm going to go down and do the same one for here, Epiphone. I'm going to pick this one up. It's in uncategorized. So I'm going to say I want it to be to cost of goods sold. And then again, it's trying, we're gonna Epiphone cost of goods from now on. I'm gonna edit this and say leave Epiphone as uncategorized. Please save that as the transaction, put it into uncategorized so we can take a look at it each time. Now we've gone to Epiphone a few different times, so QuickBooks is getting insistent here. It's saying, hey, suggested rule, the rule can save you time. This is what it's saying, I'm paraphrasing. Is Epiphone always cost of goods sold? Check the following info for transactions, then create a rule to auto-categorize it in the future. So it's basically saying, hey, don't you want to use our thing here to help you out, but we're not going to do it at this point in time. So then I'm going to go back up to the balance sheet, and then it'll be the same kind of thing. If we go into the checking account now, of course, we're going to have those decreases to the checking account. Now, with regards to the Epiphone and Gobson, I spelled it wrong, but there they are. So there's those transactions. Again, they're going to cost of goods sold is the other side on the split side of things. It's going to be a type of form, expense type form. Going back to the top, and you shouldn't use that button, but I went to the back button. That's not normal. But it didn't go to assets like they kind of should have gone, because we're doing basically a cash basis. We'll take a look at putting them to the inventory asset later, and it's not going to be tracking in the inventory reports. If I go to the profit and loss, it's going to be reflected in the cost of goods sold. So if we go into the cost of goods sold, here's the cost of goods sold, and we see these items down below, and again, they're going to be the expense items. I'm going to go back up top. Let's run one other report, or at least one other. I'm going to go back to the first tab. I'm going to select the hamburger, hold down Control, scroll down just a bit so it doesn't mess anything up. I'm going to go to Reports at the bottom, and I'm going to go to the Inventory Valuation Summary. Inventory Valuation Summary Report. And take a look at that. Now, this would be if we were to be tracking inventory, which we did for the first 2 months of operations. And I'm going to change the date to 12/31/20 and run that report. So normally this report here would tie out to what's on the balance sheet. And it probably still, if I go to the balance sheet, we still have that 672 here because it ties out, right? This gives us the detail of the type of inventory we have, which we didn't enter the system in our system. This was what we put in, what I put in for January and February. Now in our system, it's obviously this number's not going to tie out to what's on the balance sheet because we didn't put any inventory on the balance sheet in March. What we did instead is on a cash basis, expense it at the point in time of purchase. The next system we'll do in February is we will put it on the books. We'll put it into inventory assets here. However, we will not tell it what the inventory items are, because again, that's a little bit more complex. We have to set up items in order to do that. And so we're going to put it, that means this report isn't going to match this report here. That's what you're losing by doing a more kind of simplified system, and you'd have to track your inventory in some other ways. And then, of course, we have the full service system, which would be to enter in the inventory in the books when you purchase it by recording the service items, and then making the payment for that inventory. And then when the charge goes through the bank account, then you're just going to match and say, yeah, I see that. Don't duplicate it. We'll match up the transaction so that we don't have a duplicate transaction. In that format, the bank feeds would be more like a double check against our entry rather than us being dependent on the bank feeds. So right now we're looking at systems where we're more dependent on the bank rather than using the bank kind of as a double check against our books. And that's why, and as we do that, we lose some information when we're talking about like accrual accounting with regards to the tracking of the inventory. Now, if you want more information on how to track the inventory within QuickBooks, you'd have to look into the full service cycle, which is basically to go down to the sales information down here. And then we'd have entering in the products or services. We'd have to enter our products and services, the inventory items that we would be needing. And you can take a look at our, basically our QuickBooks courses, the full course, to take a look at how that cycle would work. But whether you use bank feeds or not, if you're going to properly record the inventory as inventory and track it within QuickBooks, you pretty much have to do the full cycle there. If you want to take a similar or quicker method of that, then you're going to lose some of the detailed information, and you got to work that into your system somehow.